divergence trading, right? So let me just move this up. Okay, so I wanted to talk about divergence trading. Firstly, you can trade it as a reversal. So if you're a trend trader, you can use it to indicate a reversal on the, say, the 15-minute or the 1 hour. But on its, if you're gonna, or you can trade it by itself as a strategy by itself. But if you're gonna trade it as a strategy by itself, then you're gonna have to trade it as on the larger time frame, so the 4 hour, the daily, and the weekly, right? Divergence isn't as complicated as it sounds. It's merely just a complicated double top and double bottom. So it's an M or a W, except what tends to happen is one point of this M is higher than the other. So the M is obviously a sell. So this point, the first M, the first point leg of the M will be lower than this higher point. And then if it's a W, which is a buy, this leg will be shorter than this leg. The importance of a divergence is essentially to find two things: a quick market reversal to get in, to get an early trade, and number two, if there's some form of manipulation, it tends to show you on the indicator, because what a divergence is basically when the chart is showing you one thing and the indicator is showing you another thing. So what manipulation would look like would be basically through the spreads being spiked up. That's one form of manipulation, and the indicator will show you essentially what's going on. But like I said, it's just a complicated M for a sell and W for a buy. We'll get into it just now. And remember the differences in the leg. On the M, the first leg is shorter than the second leg. Then on the W, the first leg is shorter than the second leg. We'll get into it in more detail. Um, so let me see. So yeah, like I said, on you can trade on the lower time frames, but then if you do that, then you're gonna have to trade it with another strategy in combination with it. So what indicator do you use? I use the TDI indicator, but you can use the RSI, you can use the MACD, you can use the oscillator. They all work. Let's get into it. Right. So what I was essentially saying, say this is a buy. On the buy, remember buy is like a W. This is the first leg, right? It's quite high. The second leg is even lower. So essentially it forms a W formation, right? W formation. So you'd be looking to buy in here. But how you would see the opportunity is essentially this is the low. And if the if the indicator was showing what the chart is showing, you'd be seeing this downward slope, right? But the indicator isn't showing that. The indicator is showing an upward slope. And that's what we mean when we say that the chart is showing one thing and the indicator is showing another. So here's a high point and then an even lower point. But on the indicator, we're seeing a high point and then an even higher point, which signals to us an uptrend forming. And so we want to get in on this leg here. So since this is daily chart, you could trade as just a divergence, and see they're using the RSI indicator. So an example of a bullet or bearish divergence, since we've just looked at bullish divergence, here's a bearish divergence. Again, this is an M, so it's not the W, it's the M when it's a sell. This is a lower high, and this is a higher high. So importantly, when divergences form, it will usually tend to knock out a lot of stop losses. Because imagine if you had bought in here or you bought in here, you would immediately get stopped out. So divergences are also good for people who are struggling with getting stopped out. It's just a good entry. Imagine if you got in here, price goes even higher and tags you out, and then ends up going in your direction. The broker doesn't stop hunting you. That's not what's going on. Essentially, markets take time to reverse, or it could be a spike of the spreads, which causes these funny candles. So if it is a spike in the spreads, divergence still helps. So let's look at a bearish divergence. Here's the high, here's the even higher high, but it's still an M formation, right? And then the continuation. So we'd expect to see the same thing on the indicator, but we don't see that. We see a high and then a lower high, a high and then a higher high. So it's sloping up, but here on the indicator it's sloping down, indicating a sell. So here's where you'd want to sell on this RSI where it's starting to fall. This is a daily chart, and here's with the stochastics. You can also use the stochastics indicator, as you can see. But if you use the stochastics indicator, you're gonna have to wait for the red and blue line to cross over, or whichever colors you use, in order to form that leg. So if it's a buy, we're looking for a W, right? So here's the low, even lower low, right? The second leg of the W. But here we see an upward slope, and we're looking for an entry here. And then here we go. So it's actually forming a high. This was the low. This was the higher low. Here we saw a low and a lower low. But here we saw a low and a higher low, right? Essentially, the charts are showing something different from the indicator. And then this is the after. This is what happened right after. The W formed, and then the trend continued. So like I said, you can combine the divergence with trend trading, for example, in order to get accurate entries. It's a good way to combine, say if you're a trend trader, to use divergences. There's also a danger in entering too soon, right? That's always a danger with divergence trading, and there's essentially nothing you can do about it. What you can try to do is modify um, your stochastic settings, maybe possibly waiting for the red and the blue line to cross over. That's another method, or you can do it the old-fashioned way and sort of give your trades 30 minutes to an hour before you enter. Or you could do what I have here, which is a downward trend and then the break. So basically, essentially what we're seeing on the charts is a downward trend, and this is where the divergence happened. But before you enter, here's the downward trend. You want to wait for a break first before you enter. This is just to get a better entry with divergence. Yeah, so let me show you. It's important for me to show you also what I'm working on, because obviously just seeing it there looks kind of strange. So on a practical chart, it would look something like, for example, I like to trade patterns, right? So, and trends. So I'm a trend trader and I like to trade patterns. Here was the beginning of a downtrend, right? This was a rising wedge, and I was anticipating a downward trend. So my entry was determined by this divergence here. Here's the divergence and then the entry. So let's see if I can show you. It's not so clean when you look at it like this. Yeah, it's not too clear. This one's not too clear, to be honest. I would have to go down to the lower time frames to see if I can show you clearly what the divergence looked like. Right, here we go. So here's our settings. Essentially, if you look on the 15-minute, there was a clearer divergence, a sell. So here was the low, and then this was the higher high, right? Lower high, higher high. So if you sold here, price spiked up even further. Then obviously your entries would get stopped out, which is why a divergence is really good for entries, right? It's a way of confirming your entry. And then currently I think I did talk about this this position that I'm entering into. So here's another divergence. So the pattern I had identified was a rising wedge. Here was a rising wedge. To continue the pattern we've already been seeing, this is my target area. This wasn't my entry, but this second entry, which formed a few hours ago, I think around 3 or 2 a.m., here was the entry, the divergence entry, right? So let's look at a chart. Here's the stochastics indicator. Say you're using the stochastics indicator. This is actually pretty clear. You can actually see what's going on here. Notice how price was at this point and then went even higher at the second point. But on the indicator, it doesn't show that. On the indicator, we see this high, and then for some odd reason, price remained low. It didn't go all the way up there. And I'm not too sure whether we can say it's market manipulation or we can say it's just the charts showing delayed data. I don't know. But what I know is that's what a divergence essentially helps you to do, to get a good entry, and also to to get a good entry and to avoid getting stopped out. Now you don't have to use divergences. There are other things you can use. You can use Fibonacci and other patterns. It's not a must that you understand divergence. If it's not something you like, and also with divergence, you have to be very careful which indicator you use. Like I said, you can use stochastics, you can use RSI, you can use MACD, but the one I've seen the best results with is the TDI indicator. I'm sure if you scour around the internet, you'll find it somewhere. I know people will sell it to you for a lot of money, but I'm sure if you look for it, you'll find it. The best one I've seen is the TDI indicator. Yeah, I used to use it on the 1 hour, but now that I still use it sometimes if I want to trade on the 1 hour, but not on patterns like this where it's very clear, because then it's unnecessary to load the indicator, and then it just takes a lot of time. But that's pretty much it. That's pretty much the divergence. It's not that complicated. If you can see, this looks like a double top. It's essentially just a double top with a higher second leg. So this is the M for sell. This was the higher second leg. Price went down. If it was a buy, we'd see the exact same thing. All right. Yeah, that's pretty much it. Let me see if I can find on the rand. I want to see something. Right, exactly. I think there's something on the rand here for my entry on the rand. Here was my entry last week on the rand. And let me show you. Not so clear. Right, here we go. Here was the entry. So here was the low. Since we're looking for an M, no, for a W, sorry. For a W for a buy, this was the first leg, which is pretty normal, what we can see here. And then we saw this sharp drop. And this point, by the way, is much lower than this point here. You can clearly see this point is much lower than that point. But how come the indicator doesn't show that? It shows the point is much higher. I'll repeat. We're looking for a W, right, for the buy. This was the first leg. This is the second leg of the W, right? However, on the indicator, we see a higher point than we should be seeing. We should be seeing this movement, but the indicator is showing an up movement. And essentially that triggered the buy. And this gap is just spreads. Let me show you how high Euro US dollar spread is. You see how high. Sometimes, you should have seen it on the close on Friday. It was literally the size of this candle here. That was the spread on Friday. Sometimes it can go as high as like this distance here. But yeah, essentially that's what it is. It helps you get good entries. And I don't think you should be too pissed. Once you go on the higher time frames, you can't even tell that it was it was an entry caused by bad spreads. It's still a great entry, even if it's a pair with high spreads. So that's pretty much it, guys.